Thanks everyone for joining me today. It's our quarterly chart party for July. So we do three things for our clients. I want to be their go-to advisor, optimize their wealth, and provide service with integrity. And if you know anybody who is in need of our services, please give us a call. Speaking of give us a call and contacting us, if you have questions about previous segments, this segment, or you want to see a question answered in a future segment, you can contact us here. With that, we're going to get right into it. What am I going to talk about today? A number of things. From an economic standpoint, what does this negative GDP quarter in Q1 look like? Are we in line for a recession? What's going to happen with tariffs? How do we feel about housing? What's going to happen with inflation? What is the Fed going to do? These are all big questions people have to answer. I'm going to run through our thoughts, as well as what's happening in the market, what's going on with the market, what's going on with the Mag 7, and what do we think the rest of the year looks like from a growth standpoint. First and foremost, real GDP, percent change from the preceding quarter, down 0.5% in Q1 2025. So we had several positive quarters in a row and one negative quarter. And why is this important? Well, this is the old data, knowledge, wisdom question. We know the data point. The knowledge is understanding the data point, and then the wisdom is knowing how important it really is. Let's talk about economic growth. So if you look at this chart on the left-hand side, we're growing at 2.1% trend line basically for the last 20 years. So, people say, yeah, it's a negative quarter. Overall, though, things have been pretty good. Yeah, we did have a negative quarter, in Q1, but it's not like we're off track. Now, you can see the Great Recession there. You can see COVID in there. But what is GDP made of? Well, it's made up of all these things on the right. Housing, 4%. I'm going to talk a little bit about housing, why we think that's going to stagnate a little bit. Investment besides housing, our businesses continue to invest, do R&D, and grow their manufacturing footprint. Yes. State and local governments, how are they doing? They're going to probably continue to expand. Federal government spending, now we just had a new major bill passed, but even without it, most government spending is already pre-locked in at continuing to grow, so we expected that to continue to go up. 70% of what you're talking about is the consumer. It's the big blue section there. When you talk about 70% of the consumer, that's most of what drives the economy. We are a consumer-driven economy. 70% of what we consume are services. Then there's some governments, and then another 10% or so is manufactured goods. But at the bottom, and this is where I want people to focus on, is net exports. We are not net exporters. We have not been net exporters hardly ever. As a matter of fact, the last time America was net exporters for several years in a row was pre-World War II. So from a net export standpoint, we tend to bring things in. And if you think about GDP, domestic product, as a garden that you'd be in, and how much you could eat is dependent on how much you could grow. But in our case, we have other people with other gardens, and we want to eat more than we've actually grown. So we borrow from other places. That's a net negative number when you're trying to account for total consumption versus total actual production. So that negative number is a big deal. Normally, it's pretty small. Why is this important? Well, it's important because of last quarter. This is the chart for net imports last quarter. You can see that big bar on the right, right? And what you really need to know is this is the last couple of years. Why is it so important? It was a big negative number. It was a much bigger negative number than it usually is. And without that negative number, if it had been more normalized, sort of like the past couple of years and really the past couple decades, probably had a growth rate somewhere in the mid 1.5 type for Q1 instead of negative. Well, that's really important. And of course, why did this happen? Well, why wouldn't it happen? We had new tariff plans announced that no one knew what were coming on April 2nd, right after the first quarter. So if you were a business person or a consumer and someone told you your favorite products or something you needed to buy that was essential to your business was going to go up in price, they just didn't know how much yet. What would you do? Would you keep a 90-day supply around? No, you'd probably make it a 6-month supply or a 1-year supply or buy things ahead of time. And that's pretty much what we saw American businesses doing. They bought a lot of stuff ahead of time in anticipation of future tariffs and price hikes. Now, why is that important? Well, it means that the GDP number was a little bit skewed for one quarter. It also means we've got to make sure we're looking at that on the other end, is if for some reason they're not buying and replacing because their inventories have grown quite a bit, which has its own costs. If their inventories have grown and they don't bring that back down, well, we might see some slightly more positive numbers in the form of lower than expected imports. in the future. So it's something to keep an eye on. But tariffs, why are people terrified about tariffs? Well, because of this chart. We haven't had tariffs like this, or possibly even similar to this, really since the 30s. And remember, in the 30s, a third of Americans lived on farms. Right? We were an agrarian society. That was one of our major exports, was agricultural goods. We were net exporters at the time. 90% of Americans didn't have electricity during this period. Today, 70% of our economy is service-based, and everybody's got electricity. Everybody's got a cell phone. Most of what we consume is services, not even goods. But you don't tariff services, we tariff goods. We thought the maximum tariff number could be 30% just a few weeks ago. Today, we think the maximum tariff is going to be more like 15. We think the actual is probably going to be somewhere a little under 10. But this is why the market freaked out. Remember, the market fell 19%, almost 20% in 4 weeks based on this uncertainty. And for us, when you talk about tariffs, we're an almost $30 trillion economy. What was set to be tariffed, because we were supposed to exclude energy, was about $1.7 trillion. That's about $170 billion worth of tariffs. $170 billion over $30 trillion is like 2/3%. And 2/3% is about what you expect in the increase in inflation as a result of all these tariffs, and assuming that business people do nothing to account for this. Importers do nothing to eat any of the costs. Sellers in other countries do nothing to evade any costs. And there's no adaptation or increase in the efficiency of the usage of these goods. So that's kind of our max presentation right now, is that, yeah, tariffs are going to come through, but they're probably not going to make as big of an impact as people think. When you're trying to talk about trade wars and negotiations, there's too many negotiations to try to keep track of, but there's really three that matter. One, Mexico. If you didn't know, we are our largest trading partner in terms of imports that we do is from Mexico. Why is that? Because it's basically onshoring. If you just want cheaper labor, you do it a mile across the border to the south. China's our second biggest partner. Our third biggest is Canada, which, by the way, this includes energy. Most of what we import from Canada is energy. After that, the number of other countries fall pretty quickly. So if you want to solve the tariff problem and have better clarity, you really need to make deals with these three countries. It solves a big part of our import questions. What effect is this going to have on inflation? Well, let's take a look at what it's had so far. Nobody expected inflation in 2021. The Fed didn't react quick enough. We saw inflation continue to increase through 2022. We got to 9% inflation. Right, that's a pretty big number on headline inflation. Today, as of May, we're at 2.4%. And if you look at this chart closely, there's a couple of different colors there. Green being energy, not really a problem right now. As a matter of fact, despite the unrest in the Middle East, as of this recording, oil's trading around $68 a barrel. Partially because we produce 14 million barrels of oil per day, and the Saudis produce 9. We're net exporters of energy now. We're less dependent on foreign oil than we ever have been, and the unrest in the Middle East doesn't nearly affect the oil price here as it did, say, 20, 30, 40, 50 years ago, even as much as 10 years ago. But if you look at this, food at home has come down in terms of overall increases, and inflation is a measure of increase. I realize the prices are still higher than they were 7 years ago, but we're not as good at measuring the rate of increase. We're good at measuring the total increase, but this is about the rate. Core goods would be orange. We haven't really seen major inflation come through in core goods yet. Doesn't mean it won't be seen, but it's probably not as prevalent as we'd expect. We had core good inflation in 2022 of close to 2% of the whole number, of 9 was just from core goods going up. Dining and recreation still a little bit higher, but the biggest piece here is shelter. And shelter peaked in January 2023, really through June of 2023 in terms of increases. And today it's still almost 2/3, it's well over half of the total inflation increase is just the rent equivalent yield, or what are we paying for shelter? And even the Fed admitted just a few weeks ago that that's probably coming down. And it's probably coming down because of these two charts. Borrowing rates, I think no one is surprised by this, are much higher than they were just a few years ago. The average 30-year mortgage right now is closing at about 6.5%. The 10-year Treasury note's a lot higher, and the effective fund rates, Fed funds rate, is a lot higher. But interestingly enough, that chart on the left, home sellers outnumber buyers right now by about 500,000. So there's a lot more people looking to sell than looking to buy. That wasn't the case just a few months ago. Right? You go back just like 18 months ago, you had almost the same number of sellers as buyers. By the way, you had a lot more buyers in 2021, 2022, 2023. Why is that? Everybody's trying to do the remote location and get that locked in. Well, that slowed down a lot with rates coming down. Right? And then we saw a market stabilization, and now we see far too many sellers. Well, guess what? You remember your high school economics class. When there's more sellers than buyers, what tends to happen to prices? They tend to fall, or certainly not rise as fast. So probably the biggest portion of inflation left is probably looking at continuous decline, and that's what the Fed is expecting, and that's kind of what we'd expect as well. Speaking of expectations, inflation expectations are really important because the Fed is always worried that inflation begets inflation because people expect inflation, so therefore they inflate their prices and then they cause inflation by expecting inflation. That's why inflation expectations are important. Let's take a look here quickly. When you look back at these two lines, there's one, the gray line, which is the next 5 years expected inflation, and the blue line is next year's inflation. Even in 2021, 2022, inflation expectations rose to 5.5. Remember, we got 9. So we got a lot higher than that. But inflation expectations came down pretty rapidly in 23 and 24, kind of to where they ended up actually being. But now, this data is a quarter old. Inflation expectations have soared through the roof. And for me, this feels a lot like generals fighting the last battle. Even under huge stress of not being able to import things for months. Remember, there was, ships waiting outside San Francisco we couldn't get anything for a while there. We had like 2% inflation as a result of goods increases. And now this is sort of accounting for huge strides forward. We don't think this is reasonable. Next year, 6.5% inflation would be a huge change from where we are today. Right, we're at 2.4%. It's a huge increase in inflation. Even the next 5 years being permanently higher than they have been for the last 5 years seems like a bit of a stretch. But this is people's expectations. It's also one of the reasons the Fed's not in any hurry to lower rates, because if they do, they might fear that inflation again begets inflation, and they want to make sure that doesn't happen. The Fed is a very conservative organization that does not move fast. That's why they didn't move fast back in 2022, and we spent years lamenting them for it. But how is the consumer doing? Consumer's doing great for the I think 14, 15 years I've been giving this presentation. I get to say the same thing yet again. The consumer is in better straits and better situation today than they ever have been. They've got about 100, if I zoom in here on the left, about $190 trillion in total assets and about $20 trillion in debts. If you think about that, that's $170 trillion of net worth. And although, yes, inflation has been tough, the pace of wealth, the pace of income has outpaced inflation. So even after all these inflation numbers the last 5 years, the American consumer is still better off. What is most of this? Financial assets, pension incomes, homes, other items, deposits, CDs, etc. Most of the liabilities, 2/3 of it is mortgages, which, by the way, probably 50% of the outstanding consumer debt is locked in at 3% for the next 30 years. But can the consumer continue to spend? Our research would tell us, yes, they can. They're in great health. Why? We just had a recent jobs report. It was much better than expected. We had some weakness in government jobs, yes, because of some cuts going on there, but private jobs were not falling off a cliff, meaning that businesses aren't expecting to slow down as much as people think. And this is about expectations. If they continue to have jobs, and as you can see in the top chart there, the debt service ratio, what percentage of their take-home income goes to paying off debts? Except for COVID, where people got paid to stay home, basically near historical 45-year lows. So, yeah, they're in great ability to borrow if they want to, or to spend more if they want to. We are probably going to hear some stories soon about defaults. Mortgage defaults have doubled in the last 5 years. Well, they doubled from like all-time lows when we weren't even foreclosing on homes. Student loans are the orange line there. You can see this. Yeah, people are going to talk about how the defaults are screaming upward. Well, of course they are. Nobody defaulted for for a couple of years there. And if you look, it's actually still below where it was pretty much all pre-COVID. Auto loans are about where they were pre-COVID levels. Credit cards are maybe slightly higher than they were pre-COVID levels, but they're nowhere near where they were in recessionary levels or the tech bubble bursting levels. So consumers are in overall a good position. But going to the Fed is trying to engineer what we call a soft landing. When you're trying to engineer a soft landing, the last time they did it was 1983 through 1999. And let's take a look. It sort of looks like a tabletop. It goes sideways. They realized they raised a little bit too much. They lowered a little bit, and then they kind of went sideways for a while. It's probably not too far off from what we should expect them to do here. The green line there is what the market's expecting them to do. The blue line is what the Fed thinks they're going to do. In any case, we're probably expecting a couple more cuts this year, maybe two. But their long-term expectations are to get to like 3.4% on the Fed funds rate. We're not that far. It's like 100 basis points or 1% from where we are today. But the Fed does not want to cut too fast. The Fed got chastised a lot for not raising rates quick enough. They certainly don't want to let inflation back out of the bag and get blamed again. Right? That's why I said they're a very conservative organization. And the Fed is ultimately, as Milton Friedman put it probably best, the fool in the shower. They don't know what's coming down the pipe, but they keep playing with the knob. And when the water is cold, they turn it all the way to hot and hope that it gets there quickly. That's what we saw with the big raises in 2022. And eventually when they realized it was burning and it was too much and they didn't know what to do, they started cranking it back. And they usually overcrank it one way or the other. Right now they're just tinkering with it, but if there's a major recession or a major emergency, they'll slam that thing all the way down. That's what happens. They tend to turn it one way in one direction for a while until something seems to break or something happens, and then they sort of back off. That's what they did back in 18, right? They kept raising rates all of 16, 17, and then into 18, and then by the end of 18, something broke, and then they lowered them back down again. This is a common occurrence. But we shouldn't expect rates to go back down to near 0% on the Fed funds rate. But what does that mean for long rates? And what does it mean for the economy? Well, bond investors are great predictors of the economy because they have to understand inflation. They have to understand future expectations. The dark blue line is pretty much where we're at today. If you expect things to get better, you should expect that longer rates should be higher than shorter rates, right? Because you're expecting things to keep getting better. Today, you've got a little bit of an inversion there between the Fed funds rate and the 10-year. But ultimately, the 10-year, when we call it inverted, we're really talking about the 2-year and the 10-year, which is what we saw on the green line there, the maximum inversion standpoint. The expectations were bad. We expected things to go down from there. Well, we know, and everybody pointed out here, 2020, 2023 is on there twice. Things did get better. So it wasn't necessarily what happens, but it is about expectations. The expectation now is that things would get better, and we probably see Fed funds rates come down. But if you were to sort of draw the curve with your eye, you'd see they're probably going to land about 3.5% or so, which is 3 cuts away from where we are today, just about maybe 4. If that's the case, we're probably not that far off. Probably means we shouldn't be expecting 2-3% more cuts on the Fed funds rates. The long part of the market is controlled by the bond investors. The short is controlled by the Fed. And then the long-term bond investors are saying we think things from an economic standpoint look pretty good going forward. So where does that leave us from a market standpoint? Because I talked a lot about the economy. Let's talk about how does this affect the market. Well, one of the things we did say just in our last quarterly chart party was about policy uncertainty. When you have maximum policy uncertainty, it's usually when you get the bottom of the market. And that's, in our estimation, exactly what we got. We got max policy uncertainty right before we knew it was going to happen. As soon as we got Liberation Day, we didn't know quite how this was all going to shake out. But we got a big downturn, right? 19% in 4 weeks. It was a big move down. Today, realistically, the market's hitting new highs again. But not that much has changed. I mean, we're still negotiating all these trade deals. We have a little bit more clarity as to how things are going to go. There's still unrest in the Middle East. There's still a war in Ukraine. There are still some things that are not right or that we would like to see, cleaned up. But overall, we have a lot more certainty where we're getting used to how this looks. And the idea that we've recovered all that and really through no major changes, there hasn't been a major new economic shift. And this is all pre the big beautiful bill passing. You can't point to a piece of legislation that radically changed everything back in from April to drive the market forward. This is probably just what happens. That we got policy uncertainty and the market panicked, and now we have a lot more clarity because we've gotten used to it. But whenever you have a pullback like this, you should expect a response. There's only two types of responses when you have a correction or 10% or greater decline. You either are in a recession as a result of that, or you're not in a recession. And in this case, we don't think we're in a recession. And if you look 3 months out, based on historical data, you'd expect to be up about 5%. We're up a little bit more than 5%, but interestingly enough, we're about 5% for the year. So we're probably right in line with historic averages in terms of what would happen over the next few months. That's good news. It means we're probably still in that secular bull market we've talked about. And overall, we're very happy with the recovery. Just because we had a recovery doesn't mean we're not going to still have turmoil. I know people have seen this chart, especially our longtime listeners have seen this chart many, many, many times. The red dots are how much the market fell intra-year. The gray bars are how much it actually ended up for the year. So, last year, people remembered as all we did was go up. Well, we did actually have an 8% inter-year decline, but it was so short-lived, most people forgot about it. In 2022, people remember being down 19, 20%. They forget we were actually down 25 at one point in that October. 2021, the market did go up 27%. We had a 5% inter-year correction. It felt like next to nothing. 1995, 3% correction, all going up 34%. Pretty powerful move. Now we've had 19% correction, and we've recovered. Now we're basically up 5-6%. We get turmoil every year, but we have to remember that ultimately, what are we looking for? We're trying to make long-term predictions. Right? When we buy any sort of stock, we're thinking about what do the next 5 years look like, and we want to follow this chart. Stocks go up because earnings improve. Right. I can zoom in on this chart, but the key thing here is profits. The more profits these companies make, the more their stock prices go up. And there's a 0.97% correlation with that. 1% would be perfectly correlated. We know they're not perfectly correlated because there's a lot more market fluctuation than earnings reports. Near perfectly correlated over time. So if it's near perfectly correlated, we have to look at profits. Profits tend to come when the economy is growing, right? When the economy is shrinking, it's harder for these companies to make money, but we are looking for profits. We look at the price index just here recently. Secular bull market started in 2012. You can see even with the disruptions we've had, COVID, the pullback from the Ukraine invasion, and then even just recently here with the tariffs, we're still kind of in a straight line from where we would have thought we would have been following that move from 08 all the way into 19. It's been relatively orderly. Things have been really, really positive over that period of time. But I want to talk about profits, because profits are ultimately what are going to drive the market higher, combined with the price we're willing to pay for profits. And those are the two things I'm going to spend a little bit of time on here next. Profit margins are near all-time highs. I mean, they look fantastic. But let's talk about profits, because they're not always directly related. When you look at, for instance, 2020, the market fell 34%. Profits only fell 14%, and then it didn't fall 34%. We recovered, and we had a net higher year that year, even though profits were down. 2021, we had an incredible year, explosive growth in the market. Guess what? Earnings per share was up almost 50%. Yeah, of course the market should have a great year that year. 2022, terrible year. We just talked about that. The market was down 20%. Profits grew that year by 5%. Revenues grew strongly that year. 2023, 20+% year in the market, massive growth, zero net new earnings per share growth. Right? 2024, another stellar year, only 10% net new growth. So in the last 2 years, we've seen 2 years, 2023, 2024, we saw 20% plus returns in the S&P 500. And one of those years, earnings grew 0, and the next it grew 10. Why is that important? Well, it goes to what's going to happen this year. Well, this year we thought earnings were going to grow around like 10%. And right now it's kind of shaping up that way. Next year we're expecting closer to 14. But you don't just value stocks on earnings, especially in the short term. You value it on what we call price to earnings or price to forward earnings. What are we willing to pay for a dollar of earnings? In this chart, this is PE ratios. On the very left-hand side of the chart, that's the tech bubble. That's 99. We were paying 24 times earnings. Now, luckily, this isn't on the NASDAQ because the chart wouldn't fit. But in the S&P 500, we were paying 24 times earnings. And although we had the shortest, shallowest recession in U.S. history, we spent the next 8 years repricing the market from 24 times earnings all the way down to 7. And then when we got to 7, we had a massive recession, the worst recession we'd seen since the Great Depression. So yeah, you got cheap prices for stocks, but you had underlying crumbling fundamentals. In 2012, you were paying extremely low prices for stocks, and that's when we thought the secular bull market started. And it continued to grow that during that period, and we had exceedingly increasing in fundamentals, and the market kept going up, and it has been since then. And in 2020, we hit 22 times earnings again. Went all the way back up there. Now, in 2021, we're back to 22 times earnings. Earnings were also growing at 50%. It felt very justified. And remember, earnings then in 2022 grew 5%. You can see there's that dip right in the middle, right at the far right-hand side of the chart there. It's not that earnings went down in 2022. It's that we repriced the market from 22 times down to 17 times. That was what drove us down 25%. And we spent the last couple of years going back up to 22 times, despite earnings being 0 and 10%. And even this year, we're at 22 times earnings. And if you remember, going all the way back to our first chart party of the year, we said if we keep trading at 22 times and we grow by 9% this year in earnings, we should expect the market to end up about 9% higher. Because I guess the question is, how much are you willing to pay for a dollar of earnings? Traditionally, we pay $17 for a dollar of earnings. You pay me $17, you get a dollar earnings back, and because it's a stock, you're hoping that next year it's not a dollar, that it's $1.03, and then $1.07, and then $1.14, and it keeps growing over time. But we're trading at 22 times earnings. We're trading near historic highs. It seems like it's if you want rapid growth in the market this year, best place to get it is probably for more multiple expansion. And for us, that seems like a harder thing to look for. We've been asking for more multiple expansion in 2012, 13, 14, 15, 16, and we eventually got it. But right now we're at 22 times. It seems like it's going to be tougher to come by. If that's the case, even repricing the market down to 20 times earnings, that's a 10% haircut in the market this year. If we were repriced back to historic norms at 17 times, that's a 25% haircut to the current price of the S&P 500. That's a big move. Do I think we're going to do that? No. I think what's ultimately going to happen is those two things are going to come together. We're going to see the price to earnings ratio come down as you see an almost offset of new earnings come into play, and eventually we will reprice the market, but it will take some time, and it caused the market to go a little bit more sideways during that period. And I'm going to touch on another chart about that at the end here. The last thing to touch on is the Magnificent Seven, because I still have to talk about it because it's been a wild ride. When you look at this, they're currently trading the top 10 names in the S&P 500 are currently trading about 30 times earnings. To a historic average of about 20 times earnings. If you look, the remaining stocks are trading at 20 times earnings based on against their average of about 16 times earnings. So yeah, realistically, everything's a little bit higher than it usually is from a historical basis. That's not necessarily a bad thing. That's not a reason to run for the hills. That just means it's time to be a little bit more cautious about what you're buying and making sure that you're paying fair prices for the future growth expectations. One of the challenges we do have, though, is that the top 10 stocks are 40% of the market. And the NASDAQ has made calls to address this. The S&P 500 committee has made calls to address this. The Russell 2000 has made calls to address this. This overweight is problematic, so much so the IRS has announced they've started to investigate mutual funds and ETFs for not diversifying as per the rules in order to remain as a mutual fund or an ETF. So we're seeing a vast overconcentration. If I told somebody I bought 500 names, most people would be very disappointed to find out 40% of it were just 10 names. Right? That would seem like a very serious overweight. And that's really what these things are right now. They're a major overweight, and they are driving the market in all sorts of different directions. In 2021, yes, the S&P returned 27%. A third of that return was just from the Mag 7. In 2022, the market went down. The Mag 7 was down 40%. Right? The rest of the market was down 8%. So again, 56% of the market was driven by just 7 names. 2023, 2/3 of the market was just 7 names. 2024, half the market. Right now, 23% of the market is just those 7 names. So we're seeing it broaden out a little bit, probably not quite as quickly as we anticipated. But yeah, the S&P is up a little more than 5% this year. Most of that is actually from ex-Mag 7 names. But if we've had this kind of powerful move, this reminds us, what should we expect next? Well, we think that PE ratios are near the top, so we have to expect a lot of earnings out of these companies and might expect things to go sideways. And when you have what seems like a surefire shorthand for how to win the market, you can go back and research how things have worked out with the Nifty 50 back in the 60s. They were a disaster in the following decades. Oil companies, all you need to buy in the 70s, were a disaster for all the 80s and 90s. Right? The 80s and 90s, all you need to do was buy tech and .coms, and that was a disaster. Right? Microsoft hit a new high in 2000, and it took 17 years to hit a new one in 2017. From basically 2001 to 2007, all you had to do was buy housing stocks and financials, and that was a disaster for the following period. Whenever you get to the point where it's an easy shorthand, it's usually much more. We want to be a little bit more leery about what that actually looks like. So our future expectations right now, this is brought to our friends at KKR. Right in the middle there's 2 big lines, 2 big blue lines. One of them is 15. It's the S&P 500. That's the average annualized return the past 5 years. To even that out more to historic averages, and based on what we see, it's probably going to look more like a 6% return. This is a great case, in this case, to talk about private credit, private infrastructure, private real estate, private credit, and market-linked investments, which I've got a video on that we'll link here. But it's a great time to broaden out all of the different opportunities that people have, because it can't just be about the S&P 500. It can't just be about 7 names. And if it is just about the 7 names, we have to expect a lot more multiple expansion, which, since we're already at the top end, feels to us to be a harder road to plow. So with that, hopefully I've talked to everybody about what we think about our expectations for recession, our expectations for tariffs, our expectations for inflation, what we think the consumer and the Fed ultimately might do, and then finishing out with, I hope everybody has a very clear understanding of how we think the rest of the year is going to end up and what our expectations are for the following 5. With that, thank you for joining us. I do really appreciate it. If you find somebody else that that could benefit from this content, please share with them. And thank you. We'll talk to you soon.